Hi Vanessa, how are you doing today?
Hi Diana, I'm fine. How are you doing?
I'm good. I'm excited to have this conversation that we're going to have today. I'm particularly excited to have you here today. We are going to be discussing debt financing. We're going to be discussing debt financing and why it's important for SMEs in Kenya. So maybe you can, briefly tell us about debt financing in Kenya and why it's important for SMEs and MSMEs.
Thank you, Diana. So, debt financing as a financing option for startups, especially MSMEs, is especially important because, like we mentioned, it is for startups at present, it is the most preferred way to raise capital for their businesses, especially given the wide range of advantages it has over these other financing options like equity, equity financing, maybe. So, maybe just a brief introduction of what debt financing is. Debt financing basically refers to raising capital for your business by borrowing funds from external sources. So, this is, of course, on the premise that you're going to repay this loan and usually comes with an extent or a bit of interest. For startups, these funds could be used to, starting up the business. So we are talking operations, we are talking getting equipment, paying rent, supplies, and also hiring staff or new employees. So, like we mentioned, it is the most preferred way or the most popular way for MSMEs to raise capital right now. It stands at 42% as compared with maybe let's say grants and equity financing, which currently stand at 36 and 22% respectively. So, common ways startups have raised finances using, of course, debt is by borrowing funds from banks. Banks are the most common. We have other credit facilities, the most popular ones, the ones you can get on our apps right now, Tala, Branch, or Cash. We also have development finance institutions that just come in to generate income to small and medium enterprises or startups in the business environment that we are in right now. Yes.
Okay, that's quite interesting. Maybe to add a few, top of my mind, I'd also say SACCOs
Yes.
also provides financing to SMEs.
Yes.
That's quite interesting. So maybe you can draw the distinction for us between, debt financing and equity financing, and maybe highlight for us, the benefits or and risks with both.
Okay. So, equity financing is another way of channeling funds into a startup. So, equity involves securing capital in exchange for a percentage of ownership in the business. So, as the person, as a financier, I come and give you funds or capital in your startup, and then in exchange, instead of repaying the loan or repaying the funds, what you do is give me a percentage of ownership in the company or in the business. Now, the main difference between, of course, now equity financing and debt financing is that number one, and the most stark difference is that for equity financing, for debt financing rather, you do not ownership of the business is not diluted. This means that it doesn't change ownership, so you don't have to give a percentage or some stake of ownership in your business to the person financing. So this is important because now it makes sure rather that the startup, the proprietor of the business, still maintains ownership and still has the control of making decisions on how the business is going to go. Another main difference is that for equity financing, no repayment is needed. So for debt, as you're going to pay the loan, maybe in installments. For equity, you don't pay, but what happens now? You have to give up a percentage now of ownership. Yes, I'd say those are the most. That is the most stellar or stark difference that there is between the two forms of financing. Yes.
Okay, that's quite interesting. I think from my experience or my knowledge within this particular field, sometimes you'll find these financial institutions are would want to, get some form of security before they can, advance you this particular funds. Maybe you can tell us a bit about that.
About collateralizing the loans.
Yes.
Yes, so it is one of the, of course, when you look at factors that a facility or an institution is going to look at in once they are considering giving you a loan, or once you've applied as a startup to get a loan. Collateral is very important, especially if you're a startup, because they don't have such a history of you as a business. So they need something to hold it down or come back to as a form of guarantee that you're of course going to repay the loan, right? So that is one of the major factors that comes in for facilities or institutions that are giving out loans to startups when they are considering whether or not to channel funds in forms of loans to your business on application. Yes.
Okay, so you'd see a lot of documents like, charges of, when you have land, they might want to charge the land, or in some instances, they might ask you to, give guarantors to secure that particular facility. Is
Yes.
that common?
That is very common. So when I was talking about factors that as in the debt financing world rather, that are considered when taking out loans or giving out debt, for you get that lawyers come in handy because they're required by both parties, the lenders and the business owners. So maybe from the lender's perspective, some things they would want to check in is your credit worthiness. Are you able to repay these loans? And this goes, especially as a startup, they don't have background checks on you. So the only thing they can rely on is the proprietor's background check. So this involves a lot of due diligence, and this is where lawyers rather come in. Also, in drafting the terms and conditions of the loans, you of course have to involve lawyers to know what are the risks of this loan and what are the mitigation measures. Also, as a startup, you need to ensure that, of course, in the terms of the loan agreement between you and the lender, what are the repercussions? Maybe how are you insured, maybe for lack of a better word, or how are you protected from personal liability, for example, in the event you're not able to repay your loan on time? Is it an agreement that is open to restructuring, such and such things? So yes, there's a lot of drafting, a lot of negotiations that happen in terms of lending and getting debt that require the services, of course, of a lawyer or an expert.
Okay, that's quite interesting. Especially, listening to or looking at it from, both sides of the coin, like the financier's perspective or and the proprietor's perspective. Yeah. What key factors would you consider as a financier when, taking on debt financing? And maybe you can also tell us about factors, a startup should consider before they seek this kind of financing.
Okay, thank you, Dana. So as a financier or the person or institution giving out the loan, the first thing to consider, if I come as a startup proprietor to ask for a loan, the first thing to consider is the viability of my business. And the viability of my business includes looking at a lot of factors. What is the business? What is the environment? The regulation mechanism? What is the background works behind the sort of business that I'm starting? Is it viable enough? Does it look like it has prospects for profitability? What are the government policies in that niche or area of business I want to start? Also, another factor to consider that I mentioned before is my credit worthiness. So how can I be trusted? Can my business be trusted with a loan and be trusted, of course, to repay it, given the kind of idea that I'm fronting to run the business? As the startup or the proprietor starting the business, taking out a loan, the first thing to consider, of course, is the assessment of your financial needs. You see, once as a business proprietor, you have a plan on what you want this money for, you're better placed to realize your goals as in the business rather than just taking out the loan because you want to start. It's better to have an assessment of your financial needs. Number two, it's also important to check the terms and conditions that are being given for this loan. You don't want a loan, of course, that you can't repay, it's too fast, the repayment terms are too fast, and you know that at this point my business will not have started making this much money, or the turnover won't be as good to place me at a position to repay. Also, you don't want a loan that, like we mentioned before, places personal liability on you as the business owner. So the terms and conditions are very important. You should also be able to check for collateral as a term or as a condition of the loan. What are they asking for? Do you need collateral to secure this loan, and do you even have that much, or are you able to risk that as a business? Yes.
As we wind up, what would you say are the emerging issues in this particular field, in this kind of financing, and what are your takeaways in respect to those particular issues?
um I think right now, given the kind of economic or financial environment we are in as a country, and given that we are in times that are not very, we do not really know what to tell of the future of business and how the landscape itself is going to be. As a startup, I feel like it is very important that proprietors start considering the flexibility of whatever financial financing options they take on. So this is looking at options that allow you to align your payment schedule with your cash flow patterns and cycles as a business. So you want an option that allows you to restructure some of these terms, terms of payment, terms of interest, terms of duration of paying the loan, or coming up with the finances to give back from wherever the investor or financial whatsoever party brought them in. So at this point, flexibility is really key, especially, of course, given the kind of uncharted times you're in economically as a country.
Okay. Thank you, Vanessa, so much for coming onto this particular platform today and for sharing your insights with us. We're really grateful we got to learn from you, and we hope to hear from you more.
Thank you, Diana.